Did you know that there are really only 2 rules for investing? Only 2. I'm going to talk to you about them right after this.
The strongest prison bars are in your head. Leaders and teams, it's time for a jailbreak.
Well, hello. I was just not quite quick enough to put this on. There it is, my personal page. So we're going live to YouTube, LinkedIn, Trish TV, Facebook page, and now the personal page. So feel free to join and make a comment, whatever you'd like to do. All right then. So where does she get off saying there's only 2 rules for investing, and what would she know? Oh, I know a little bit about investments going wrong. Spent 8 months in prison because of a corporate breach and working for a fellow who turned out to be a crook. But one thing I know is even if you invest your money with someone who turns out to be a crook, if you follow these 2 rules, you'll come out relatively unscathed. You will come out better for it. So what are they? Well, it goes like this. To date, I've never had an investment guru, a financial planner, an accountant, or a liquidator disagree with what I've talked about. I bring this up every time I do finance. Okay, so we're talking about this because resilience involves finance, and I have some expertise in the financial background. I do not give financial advice. But one thing I've seen time after time after time, these 2 rules. There's all sorts of rules for investing. There are all sorts of rules to do with candlesticks, to do with when you put your money into an investment that might be to do with a business, when you go into partnership with someone. And I do cover a lot of due diligence strategies and questions you need to ask in my 2 books on investing, which is on due diligence. But the 2 rules, I'm building up because I really want to drum these into you. When we lost everything, we didn't actually go bankrupt because we were able to keep going because of these 2 rules. Now, I know them better now, and we weren't really conscious of it then, but here's how they go. There are only 2 rules for investment. Number 1 is never invest more than you can afford to lose. Sounds simple? People do it all the time. They kid themselves and they talk themselves into something because their emotions want it so badly. But if you, whether it's $500, $5,000, $20,000, $1 million, if you cannot afford to drop it and lose it, you've got no business in there. Real estate is slightly different in that, you don't want to invest more than you can afford to pay. But usually when it's a house that you're living, you're either going to be paying rent or you're going to be living in a house paying a mortgage. In that case, you'd want a mortgage that you can afford comfortably with some margin in it. But when it's speculating, when it's stock market, when it's something that could go wrong, if you never invest more than you can afford to lose, you already do that sum. If you can afford to lose it, go right ahead. If you cannot lose that money, you've got no business being anywhere near it. You just don't. So what's rule number 2? Are you ready for rule number 2? Maybe I'll tell you after this, just a second. So I mentioned last week that I had done an investment and I had accidentally made 60% on my money, which sounds amazing, but I could just as easily have lost it. And I trade certain days of the year. I don't day trade anymore. I can't fill my head with that stuff. It takes up too much room. But when I invest, there's certain days of the year that I trade. And one is the lead up to Chinese New Year, because gold always goes up. Almost always goes up. It is likely to go up for various reasons, which I won't go into here. And what I did was I miscalculated on my bank. So I have a certain amount of bank that I use that I can afford to lose if it goes wrong. And I miscalculated how many contracts I was going to go in with. So I actually went in and I went long with double. So long is when you buy, you want it to go up. And short is when you want it to go down. Double. And so instead of making the estimate, and my limit and my stop were the same distance. I had a $25 target limit and a $25 stop. And I had 20 contracts when it should have been 10. I miscalculated. And so, well, the trade, there was a miscalculation and I did double. So I could just as easily have lost 60%. But that money that I use in that trading bank is money that if it blows up, it blows up. It's a bit like if you go to the casino. If you go to the casino to have some fun, you say, I'm going to allocate $100 or whatever, and I'm going to have some fun. And if I make money, great. If I don't, that's okay. And you've had a good time, that's fine. But if that's your grocery money, you got no business being there. So there's that. So rule number 1, never invest more than you can afford to lose. Rule number 2, are you ready for it? See rule number 1. Yep, that's it. See rule number 1. If you cannot afford to lose it, you got no business being there. But if you can, take the risk, calculated risk. If you want to learn about how to take calculated risks and what to investigate and to ask, well, I have 2 books. One's for women. I wrote that first, Dangerous Wealth, What Every Successful Woman Needs to Know to Avoid Being Ripped Off, and the gender neutral version for the fellas. It's the same book. So don't buy both of them unless you're buying them for different people. But they've got checklists, questions, all that sort of thing that you need to ask when you're too. It won't guarantee you won't get ripped off, but it might narrow the odds for you so that it's less likely. I won't go into all of that now because this is just one of my short daily videos, but I hope you've enjoyed that. Once again, the 2 rules. Never invest more than you can afford to lose. And number 2, see rule number 1. Okay, well, have fun. Have a great week. I'll look forward to seeing you tomorrow, where this week, every day will be something about resilient finance. Ciao for now.